Mastering Your Money, A Guide to Personal Financial Planning. Chapter 3, Debt Management. 3.1. Types of debt and their implications. Debt refers to money borrowed from a lender, which needs to be repaid according to agreed-upon terms. There are various types of debt, each with its own implications. Here are some common types of debt and their implications. 1. Credit card debt. This type of debt occurs when you use your credit card to make purchases and carry a balance from month to month. Credit card debt often comes with high interest rates, which can accumulate quickly if not paid off in full. It can lead to financial stress, impact your credit score if not managed properly, and restrict your ability to access more credit. 2. Student loans. These loans are taken out to finance education expenses. Student loans typically have lower interest rates compared to some other forms of debt. However, they can still be substantial and may take years or even decades to pay off. Failure to repay student loans can negatively impact credit scores, restrict future borrowing opportunities, and potentially result in legal consequences. 3. Mortgage loans. A mortgage loan is used to purchase a home or property. This type of debt is usually long-term and secured by the property itself. The implications of mortgage loans can vary depending on factors such as interest rates, loan terms, and housing market conditions. Defaulting on a mortgage loan can lead to foreclosure, which entails losing the property. 4. Personal loans. Personal loans are typically unsecured debts that can be used for various purposes, such as consolidating debts or financing major expenses. The interest rates and repayment terms can vary based on factors such as creditworthiness and the lender's policies. Failure to repay personal loans can damage credit scores and may result in legal actions by creditors. 5. Auto loans. Auto loans are taken out to finance the purchase of a vehicle. They can be secured or unsecured, depending on the lender's requirements. Defaulting on an auto loan can result in repossession of the vehicle and negatively impact credit scores. It's important to manage debt responsibly by making timely payments, understanding loan terms, and borrowing within your means. High levels of debt and missed payments can lead to financial instability and affect your overall financial well-being. Prioritize paying off high-interest debts first, and consider seeking professional advice if you are struggling with debt management. 3.2. Strategies for reducing and managing debt. Sure, here are some strategies for reducing and managing debt. 1. Create a budget. Start by evaluating your income and expenses to get a clear understanding of your financial situation. Identify areas where you can cut back on expenses and allocate more funds toward paying off your debt. 2. Prioritize payments. Make a list of your debts, including the outstanding balances and interest rates for each. Focus on paying off high-interest debts first while making minimum payments on the others. This will save you money in interest payments over time. 3. Snowball or avalanche method. There are two popular approaches to paying off debt. The snowball method involves paying off your smallest debts first and then moving on to the larger ones. The avalanche method involves prioritizing debts with the highest interest rates. Choose the method that works best for you. 4. Negotiate with creditors. If you're struggling to make payments, consider reaching out to your creditors to negotiate new payment terms. They may be willing to lower interest rates, reduce monthly payments, or provide alternative repayment options. 5. Avoid taking on new debt while paying off existing debt. It's important to avoid accumulating new debt. This means refraining from using credit cards unnecessarily and spending within your means. Stick to cash or debit cards for your purchases. 6. Increase income. Consider finding ways to increase your income to accelerate debt repayment. This could involve taking on a second job, freelancing, or finding other sources of additional income. 7. Seek professional help. If you're struggling to manage your debt on your own, consider consulting with a reputable credit counseling agency. They can provide guidance, develop a debt management plan, negotiate with creditors on your behalf, and offer financial education. Remember, managing debt takes patience and persistence. Stay committed to your repayment plan and make consistent payments, and with time, you'll be able to reduce and eliminate your debt. 3.3 Credit scores and their significance. Credit scores are numerical representations that reflect an individual's creditworthiness. They play a crucial role in financial transactions, as they help lenders assess the level of risk associated with granting credit to someone. Higher credit scores indicate a lower risk of defaulting on loans, while lower scores suggest a higher risk. The significance of credit scores lies in their impact on various aspects of personal finance. For example, when applying for a loan or credit card, lenders typically examine your credit score to determine whether to approve your application and the terms, such as interest rates, they will offer you. A good credit score can lead to more favorable loan terms and lower interest rates, potentially saving you money in the long run. Credit scores also influence other financial decisions, such as renting an apartment or securing insurance. Landlords and insurance companies often consider credit scores as an indicator of financial responsibility and reliability. A higher credit score may increase the likelihood of being approved for an apartment or obtaining more affordable insurance premiums. Furthermore, credit scores may affect employment opportunities or the ability to secure certain professional licenses. Certain employers, especially those in the financial sector, may check credit reports as part of their screening process. While credit history alone may not be the sole factor determining employment, a poor credit score could raise concerns about an individual's financial stability and trustworthiness. Maintaining a good credit score requires responsible financial habits, such as making timely payments on loans and credit cards, keeping credit utilization low, and minimizing outstanding debt. Regularly reviewing your credit report for errors and addressing any inaccuracies is also important for maintaining an accurate credit profile. In summary, credit scores have a significant impact on various aspects of personal finance, from loan approvals and interest rates to rental applications and employment opportunities. It is essential to understand the significance of credit scores and work towards maintaining a positive credit history. 3.4 Responsible borrowing and avoiding common pitfalls. Responsible borrowing is important to maintain financial well-being and avoid falling into common pitfalls. Here are some tips to help you borrow responsibly. 1. Assess your needs. Before taking out a loan or using credit, evaluate if it's truly necessary. Borrowing should be done for essential expenses or investments that will bring long-term benefits. 2. Create a budget. Have a clear understanding of your income, expenses, and financial goals. This will help you determine how much you can comfortably borrow and afford to repay without overburdening yourself. 3. Compare options. Explore different lenders or credit providers to find the best terms, interest rates, and repayment plans. Research and compare before making a decision to ensure you're getting the most favorable terms for your specific situation. 4. Read the fine print. Carefully review the terms and conditions of any loan or credit agreement before signing. Pay attention to interest rates, fees, penalties, and repayment schedules. Understand all the details and ask questions if anything is unclear. 5. Borrow only what you can repay. Never borrow more than you can realistically afford to repay. Consider your income, existing debt obligations, and monthly expenses to determine a comfortable repayment amount. Avoid overextending yourself as it may lead to financial stress. 6. Keep track of your debts. Maintain a record of all your loans, credit card balances, and repayment schedules. Stay on top of due dates and avoid missing payments, as it can negatively impact your credit score and result in additional fees. 7. Avoid reliance on credit cards. While credit cards can be convenient, excessive use can lead to high interest debt and financial strain. Limit your credit card usage to manageable amounts and pay the balance in full each month to avoid Accumulating interest charges. 8. Communicate with lenders. If you face financial difficulties or anticipate trouble repaying a loan, contact your lender immediately. Many lenders have options to modify repayment terms or offer assistance programs to help borrowers in challenging situations. Remember, responsible borrowing involves making informed decisions, using credit wisely, and staying proactive in managing your financial obligations. By following these tips, you can avoid common borrowing pitfalls and maintain a healthy financial future.